Hello, everyone. Thank you for showing today. This is Christian, and this is another episode of Real Estate Talk, where I usually talk to other real estate investors and fellow Facebook friends about the real estate industry, the lending industry, and the different perspective that they have on what's going on today and the trenches, and share some good ideas and tips and different opinions from different friends in the real estate industry. But today we're going to be by ourselves. You're going to be talking with me today. We're going to be talking about fix and flip loans and financing for with hard money, private money, and some unsecured money too. So the idea is to kind of give you a perspective of how you need to look at financing today to be able to structure your deals and how you can get the financing that you need. So the idea is to give you some information on how you have to think about your deals when you're looking at properties, when you're looking at fix and flip deals, even rental properties. Okay, the idea is to give you some extra information about that and see if we can help you somehow in your in the way that you look at deals and the way that you structure them. Okay, so we're gonna get right to it. So the idea today, I'm gonna share my screen in a little bit with you. The first thing that we're gonna talk about today. Let me take this screen off up here, and we're gonna do this. Okay. So the idea today we're going to be talking about is different type of real estate loans and for fix and flip specifically, and some of the rentals as well. Okay, so what is the the idea is to see what the real estate investor is thinking when he's looking at a property, and one of the things is what are the rates, whether do I need personal income for this or not, what type, how much is the maximum amount that we can borrow, the exposure limits that sometimes some of these banks are up to do it for you, and the type of properties, single family, 2 units to up to 4 units, and then even up to 20 units. What can we find about that? Okay, so using one of the first things that we're going to be looking at is using your money compared to using financing. And cash, may not always be the best option when it comes to investing. So, of course, a lot of people say cash is king, but the thing is that we need to maintain that liquidity as much as we can. So one of the best things is to figure out how to use finance in the best way possible for you, so that way you can always stay liquid and keep as much as that liquidity that you have personally or in the company for as long as you can. Okay, so and it comes with, obviously comes with its own risk and unforeseen expenses when when you're dealing with fix and flip deals, right? So by using financing, it will increase your cash on cash and your ROI by using smart leverage, right? So financing property helps you quickly jump into the next project, even if you're still working in another one, right? So the idea usually when you're investing in real estate is that depending on how much we're looking to do, how many deals are you looking to do, sometimes you're going to have a time that you're going to have deals that are going to overlap, and we have a lot of investors out there that are actually doing more than one deal at the same time, right? So I personally have done many at the same time, and that's the idea. The idea is to give you that leverage to build you up to that point where you can manage multiple deals at the same time and be able to do more, right? So the only way to do more is to learn how you can leverage your credit, how you can leverage your partner's credits, and how you can leverage your company credit, right? By building credit inside your corporation, right? Corporations can build credit the same way that we build our personal credit, right? So by building that trust in your company, by building that credit history under the corporation, is going to allow you to get access to more and more money in the future, right? And this doesn't have to take years and years. This can take anywhere from a few months to a year to kind of create that profile under your company and kind of get it started right away, right? So that way you can start creating those relationships with different banks immediately, so you can start leveraging their financing. Okay, so you'll pay some interest for sure when you use financing, but it won't equate too much, specifically on short-term loans. Usually for real estate investing, we use short-term loans rather than the regular long-term that you see for your own house or rental properties, right? So for fix and flips, usually we use short terms, meaning 3, 6 months, 8 months, 9 months, 12 months, and now even up to 18 months, depending on the scope of work of the job. Okay, so the same thing is if you need cash out, if you need to cash out some, a little bit from the property, you can easily refinance the property with these short-term loans and get some of your money out. Okay, so sometimes when you have a bigger project and you're in the middle of it and you run out of money, if the property with the improvement that you have already done on the property is worth more, there is a possibility that you can refinance the loan and do a little bit of cash out. Okay, if the value of the property improved in that area. So these options are designated for experienced investors. But if you're a new investor, do not hesitate to get in touch with us and talk about your first deal. We can help you get that done and start creating that relationship with the different lending institutions that we use and the different private money lenders that we use. So that way, you start building that relationship with from the beginning. Okay, that's very, very important when you're starting to do fix and flips. Okay, so the limits for usually for more experienced investors are usually that they have to have some transaction history in the last 2 years. Preferably will be 3 deals or more. And we can create exposure lines, credit lines for them out to $10 million. Okay, so if you already have experience and you're looking to expand your operations, if you've already done 3 deals or more, 5 deals or more in the last 2 to 3 years, definitely is something that we can create a line of credit for you and your company where you can do multiple deals at the same time, and you will have a more extensive line where you will be able to do up to anywhere from $5 to $10 million. Okay, so that for larger projects, right? Same thing for new construction and things like that. So if you're looking to jump into new construction, we can definitely do that as well. So usually, when they say that they want to see a little bit more experience, they're talking about at least 3 deals or more anywhere. If you don't have it, again, do not worry, because this is good for new investors as well. There's just a couple of different things that usually new investors gonna see that you might need a little bit more of a down payment or things like that, and you're gonna have to be careful in the areas where you're investing. We're talking about the risk on those areas, and I can help you on that. I will help you identify your area. I will help you see where you can start, what the type of property that you can start with, the loan amounts that you can start with. Different cities. We do it nationwide. So Chicago is completely different than California, right? Or Miami or New York or Texas, right? Or Phoenix. You know, for that reason is that it's very important that you get in touch with us and learn a little bit more about what's going on in your area, how the lending affects in your area, the pricing in your area, and how we can help you with that. Okay, so the idea is to help you structure that deal the right way, and you know from the beginning, so that way you don't find any um, uh, surprises in the middle of the deal. There's a lot of real estate investors that they go out, they put the property under contract, and then they go and look for the money, and then they look for financing. Um, is that's okay when you're an experienced investor and you know what you're doing, you know what to expect from your financing. But when you're new, you need to understand how financing works and how how much money you're going to need. Because even though a lot of lenders out there are saying, hey, well, we give you 100% of your construction money, you say, well, okay, well, that's great. Then I don't need any money for that, but you do. Okay, so you do, and that's what I wanted you to help you understand how that works and how much money you're gonna need to have in order to make that deal happen. Okay, so these type of loans are also relationship based. Okay, so the better the relationship, the longer the relationship that you create with the private lenders, the better, the more experience you have with them, the more loans that you close, the better your terms and your maximum limits are going to be. Okay, so in the beginning, obviously, we start with one, and then we'll see how that goes, and then that's going to be purely based on if you're a new investor, that's going to be purely based on the property, where the property is situated, how much money you can put into the deal, how much skin in the game you can put in the deal, where the property is located, how much of a rehab does he need? Because when you're new, you don't want to get into too big of a deal, too big of a rehab where it's going to be probably too much for you to learn in the first deal, right? So you're going to learn a lot by getting through the first one, right? But if you get into a full gut property project where you're going to spend, I don't know, more than 50 grand or even more than 30 grand on that project, I would say it could be too much for the first one, right? So the first one, you want to do a project that is fairly quickly, that you don't have to do major renovations, something that you can do cosmetic stuff. So that way you can kind of get your feet wet, get in and out fast, and see how everything works, how your fee structure works, how fast you can close, how fast you can get the stuff done. If you need permits, how fast you can get permits in your area, and then how do you manage your construction guys, how you manage your time, how you manage your timeline, your scope of work. Oh, there's a ton of things that you're gonna go through, that even if you learn a lot of these stuff on some of the real estate schools, a lot of it is theory, but once you're on the deal, there's a lot of other things that affects. There, the people that you work with, the emotion that you have into the deal, and the stress that brings to you. Sometimes that you want to go fast, and sometimes things don't go as fast as you want to. So all those things are things that you're going to be learning in your first deal, and of course, it's going to be something that is going to help you move into the second one, the third one, and into bigger and bigger transactions. Okay, so we talk a little bit about what's the exposure limit. What the exposure limit that banks sometimes take is the risk that they take with you, right? So is kind of like the limit, the line of credit that they can provide to you once they create a relationship with you. Is individual and business approval that allows investors to fund multiple rehabs. Okay, so when they talk about exposure limits, it's about how much are they willing to lend you, and whether that is going to be available for you to do maybe one deal, two deals, or three deals at the same time. So if you're brand new, it's going to be hard for them to take the risk with you and do more than one deal at a time. So I would say first you got to create that relationship. I would say after the third deal, probably you can jump into maybe doing two at the same time if you need, if that is something that you're looking to do. But otherwise, if you can keep it one at a time and and create more experience in the first year, that would be great. So that way you don't skip any steps on your learning process, right? So. The limit will start at 500 usually. Once you have three or more deals already done with us, I'm going to be able to get you a line at least for 500 grand, and then we can go up to 10 million. Okay, so the idea is to start with something, start with the first deal, and then we go from there, right? You pay interest on what you use only, not the total amount or the exposure limit, right? So even if you have a line of $1 million per se, but you're only using 500, you're only going to pay interest on the money that you use, not the full amount that you're being approved for. Okay. Individual in business approvals are continuous and not per property, for faster transactions. So the approval of the amount is something that is you get vetted the first time around. They look at everything, your financials and everything for your company, and once that gets approved, um, uh, then the only difference will be on each property. They're just going to be looking at the numbers. That's it. But your amount is going to be there available for you to use. Okay, so which that makes you allows you to work faster, right? To make offers and close faster, as long as your numbers on the properties, on the different properties, you got them down very good. So they're just going to review the property and done. Review the property and done. So we're not going to be looking at your company documents and your documents every time you're looking to buy a deal. Okay, so what do you need usually to get a line of credit with us? You're going to need a track record experience, right? So we're going to send you a form where you're going to put, how many deals have you done in the last 2 years, and how many transactions have you been able to close. Feel free to ask me any questions if you do have any. Okay, yeah, even if you're watching these on the repeat, feel free to message me or put it on the comments any of your questions. Okay, so we're talking about how we can get this line of credit to do real estate deals. So the first thing we're going to need is going to be a track record, experience, verification, which we're going to send you a form where you're going to put all the properties that you've done, when you bought it, when you sold it, and how much money you put into it to update them. And we're going to look at that. We're going to look at your credit. Okay, the credit doesn't have to be excellent. Okay, so don't worry about that. But it has to be decent. Okay, so sometimes as long as you have a good payment history, should be fine. Usually the credit score, they look at 620, 640 and up. So you don't need to be at 700 for these type of things, okay? Because this is asset based, so the scores requirements are not very high. But there are other options out there, that you can get access to if you have 700 credit scores and above. Okay, like unsecured money that you can utilize for these type of transactions too. So and these can be on the name of the borrower, and it can be on your name personally, or can be on your a business application, right? Which of course we all recommend to do it under your business, right? Um, and usually, for them to review that, there's going to be a fee, an application fee for them to review your company and yourself, to see if you apply for this type of line of credits or not. Okay. Property loans. For this type of renovation, it will be, residential. It has to be residential, non-owner, and obviously investment properties. Um, Residential are, the properties that are one single family property up to 4 unit. Okay, that's considered residential, and 5 units and up are considered more commercial, right? So for the residential side, we're going to be talking about today, just for residential side, um, the interest reserves are optional. If you put money in reserve, if by any chance you have additional funds, additional cash that you can put as in escrow, okay, with our lenders, we might be able to get you a better interest rate, as low as like 6.75, right? So, which you can't really see that much out there on the market. Most lenders are lending from 8, 9, 10, 11%. And we do too. But the thing is that we have an option that if you're able to put some cash in reserves, in escrow, then we can lower that interest rate down to like 6.75 at least. Okay. Sometimes even better. So funding, it can be up to 100% of your rehab cost. And that's something that I want to touch, and I want to go about with you about that, because I want to make sure that you understand what 100% means. Okay. Property loans, level and liquidity verification, that's going to, determine how much it's going to be lent to you. Draw balance options are available. The draw balance meaning, is how you're going to be using that rehab funds that that we're going to provide for that deal. And is again, and the loans can be anywhere from 6 to 12 to 18 months. Okay. We also have a bridge solution that you can utilize, but those are more for short-term loans. If you have transaction that you need to close now because you're waiting for a different type of loan to get approved. But if you don't close tomorrow, you're going to lose that deal. You can use our bridge loans that, those are quick loans that you can, fund. We can fund them with a 20% down, but, they fund usually within 7 days or so. And sometimes these are only for just a short period of time. We usually up to 12 months or 18 months if you need to hold a property that do not need repairs. Okay, this is only for when you need to buy a property that you're not able to qualify for something else, for any other loan. This is ideal for that. Just to hold an asset for a year or year and a half, if you need to, until you qualify or you are able to put it in a longer term loan. Okay. Um, we're also going to be we're going to talk a little bit about business lines of credit and how you can utilize business lines of credit with your fix and flip loans. Okay, business lines of credit is, we talked about in the beginning when we were saying, building that relationship with the lenders and building that, credit under your company is essential to start, because every that takes time, right? It takes time to build that relationship with the lenders. It takes time to create, build that credit under your company too. The same way that takes us personally build our personal credit report over the years. You got to do the same thing with your company if you want to be on these doing this in the long term, right? If you want to do fix and flips, and then or jump into rental properties, or any or Airbnbs or lease option, anything that you do with your company that has to do with real estate investing, I would highly recommend to start building not only the relationship with the lending institutions, but also with building that credit under your company. Okay, super essential, because that's going to allow you to grow and get access to more and more money in the future. And then obviously, navigate through different situations, like the situation that we're living right now with COVID. That, if you had rentals, a lot of real estate investors are suffering right now because what's going on with COVID, what's going on with people not paying their rent, not and at the same time, not being able to take the people out if they're not paying. So there's a lot of protection for that right now. So obviously, landlords out there, they're suffering too. Some of them, they're being able to defer some of their mortgage payments, but at the same time, you're not able to defer any, small repairs or anything that emergency repairs that you need to do sometimes to the property. You're not going to be able to defer those things. And by you being able to have access to capital or access to credit at times like these, it's difficult to navigate to that, and sometimes it gets you stuck in a rut that sometimes you don't know how to get out of, right? So if your property suffers damage by anything, whether or not, and something that you're not looking to claim with your insurance, it's something small, but you need to take care of it, and you don't have the cash right now. So that's when business lines of credit comes very handy, in taking, making sure that you can maintain your property throughout these tough times. Okay, and again, business lines of credit, you can get up to right now. You can get up to 150 grand at 0% interest. Okay, now they do require excellent credit history and a 700 plus credit score. So if you do have that, you can get access to a good amount of money now. If you don't, that's fine. You can still build that up over time. Okay, so this is just only if you need access to money right now. So and then also, if you're in need of liquidity, the business lines of credit is a line of credit. Okay, those are like, those are credit cards for your company. Okay, now if you need liquidity, you need cash for some reason, because now lines of credit and credit cards is the same as cash. I mean, even if you have the cash, sometimes you use your debit card. So I mean, if it's something that you can pay with your business lines, your credit cards, your business credit cards, then do that, instead of using cash, getting loans. So but if you do need loans for by any reason, if you need money for down payments or money to start up a project, we're going to go over an example in a minute, so I can show you how we can utilize all these tools that we're talking about. But if you need money for down payment, you need money to start up a project, a fix and flip, or fix up a rental, any of that, and you like to use the cash for that, we can also do that. We can also do unsecured loans that do not need collateral. Okay, so we're not going to put a lien on your property. These are loans that are unsecured, and they're good for 5 or 7 years. Okay, so you don't need to repay them right away. Of course, you're going to have a monthly payment, but you don't need, if you do a fix and flip, and you get all your money back, you don't need to repay the loan at that time. You can reuse that money on the next year. Okay, so and we're gonna check on that, and we're gonna look. I'm gonna share my screen right now, and I'm gonna show you a quick example on how we can do that. Okay, how we can utilize that. So let me share my screen here, and I'm gonna go right here. Okay, I'm gonna stay down here, and I'm gonna show you how a quick example on how you can use some of these tools with a fix and flip and a rental property. Okay, so let's say that you're looking to do a property for 100,000. I'm gonna have to switch my screen. Hold on. Um, I'm not going to be looking at this, so I'm going to be switching back and forward, but I can see that. Okay, so now, so we're gonna say that we have an example that we are looking at a property. I'm looking at actually right now. I looked at a property yesterday with one of my partners that we're looking to buy, and this property is. We're looking to acquire this property for 105. Okay. Um, and it needs about, I believe, 35,000 worth of repairs. That's a five. Okay. It needs about 35,000 worth of repairs. So total, we're going to need about 140. Okay. To do this deal. Okay, so if you need, let's say that you're in the same situation, you need about 140. Now this property, you for you to be able to see if this kind of deal is gonna work for you, you need to know before you do this, you need to know your ARV. Okay, and this is part also of the financing. Okay, so what do I mean with ARV? This is after repair value, right? So, and how do we determine the after repair value? Is when we get this property, okay, and we get three comps, okay, we get three comps at least with that has closed in the last, we're gonna say 6 months, but you can look in the last 6 months, okay, close. If you have more, better. The more better. Okay, so we're gonna put a plus in here. So 6 months, and then that they're the same type, same type of property. Okay. So this is, I'm telling you this. I know you may have a realtor that does this for you, or you may have a partner that does this for you. But I think that it's important for you to know this, even if you don't do this part of the deal, even if you have someone helping you. It's important that you understand this, so that way when you're looking at deals, you can do this math on your head and kind of pretty quickly just see if that's going to work for you or not, right? So if you have your ARV, which you can look at this stuff on your phone, okay? You can go to Zillow, okay? Um, a lot of people don't like Zillow, but Zillow is good when you're looking for comps. Zillow is not lying, okay? So a lot of people don't like the estimate of Zillow, but you don't have to pay attention to that. Don't look at the estimate from Zillow. What you're looking from here is comps, okay? Comps are real. Comps are properties that are sold, okay? That's nothing to do with the estimating price that Zillow gives you, okay? You can use Redfin, .com, Zillow.com, and or I don't know. There's Trulio, I think it is the other one, Trulio, right? And they all have apps. Okay, so you use the apps where you can find you can find all the transactions that are going on in the area. You look at the map, you look at the property, that you're interested in, and then you can see, the properties that sold around that same property. Okay, so once you get your comps, once you get your ARV, you're gonna see if this deal is gonna work for you. So let me give me 1 second. We're gonna erase this. Sorry about that. So let's say in this case with this property, the three comps that we have are looking anywhere from no, sorry about that. So the ARV that we have is about 220. Okay, 220 to 230. Okay, that's our ARV. So in order for you to see if this deal is going to work, you need to see that if out of these 220, we need to take 0.75% of that and see how much it's going to be. Let's say, let me use my calculator, 220 times 75%, that is, so that is 165. Okay, so that's 165, and that 165 I need to deduct my um, my rehab cost, right? My rehab cost is 35. Okay, so 165 minus 35,000, that gives me 130. Okay, and if I'm acquiring this property for 140, 105, right? So we're good. Okay, so we still have some room in there. Okay, now so you need to make sure that you're not over that. Okay, so you're discounting, you're making your discount, you take 75 or even less if you want to take 70%, and then at that number, this number, you're gonna deduct your rehab cost, and then this number um, needs to be um, I mean, your purchase price needs to be under this. Okay, so in this case, our purchase price is 105. Okay, so we're good. Okay, so that is something that you need to kind of make sure that you understand. So that way, when you're looking at your deals, you don't make the mistake of offering too much for it, or maybe overbidding, or or if you have your construction costs are too high, you might not be able to do it. The thing is that the lender might still lend you on this deal. Okay, but the thing is that you're going to have to pay the difference, right? Because the bank is going to say, well, look, I'm not going to give you um, more than 130 probably, right? So if you, by any chance, you go over this amount, whatever amount you're going over, you're going to have to pony up from your pocket, right? Pony up that. So your total loan to cost here is 140, right? And the lender is going to give you probably about 80% of this. Okay, so and that 80% of 140, let me take my calculator. So if we have 140 times 80% is 112. 112. Okay, so and your rehab cost is about 35,000. Okay, so you take the 35,000. So you're at 77,000. Okay, let me check if I'm not mistaken. Yeah, so 77,000. So out of what am I doing here? Let me change the color just for a second. Um, so here, um, my price here is 105, right? This is my purchase price. Okay, careful. So this is my purchase price. So now from this, my bank, my lender is gonna give me 77,000. Okay, so I'm gonna have to come up with the other. Let me see what's the difference. minus 105, 28,000. Okay, my down payment is going to be 28,000. Okay, plus fees. Okay, so that's another thing that you got to have in mind. Okay, a lot of people say, okay, how much money do I need for the closing? Well, you're going to need about 28,000 plus fees. Okay, so fees are going to be usually about 2 or 3 points. Uh, okay, 2 or 3 points, and then underwriting fees, um, appraisal, um, and then, well, you're going to have title, insurance, um, attorneys. Okay. Um, So for that, usually your title company is going to help you kind of determine how much money you're going to need for all those other things. Usually you can calculate anywhere from maybe like another 3%, depending, but if you have a 3 points on your loan, so I would say a total of, maybe 5% total on your closing cost. Okay. So, um, so we're going to put it here. 5%. Oh, I gotta switch it. So 5%. Sorry, my numbers are not coming out. 5% in closing cost. Okay. So that additional 5%, it will be maybe, if you're talking about 77,000, 77,000 times 0.5. No. So it would be another probably 77. Let me make sure that I double check this. Times 5%. It's going to be about, another $3,500. Okay, another $3,500 in worth of fees and things that you're probably going to be paying. Okay, so that plus the 28, we're talking about. Let me change here the color. So the 28 plus these, we're talking about 31.5, right? At least I'm just estimating, right? And then we have the construction, right? So the construction, let me see what color we can use for that. So we can keep using the green one. So construction we have here, we're going to have $35,000 that the bank is going to put into an escrow account, okay, for your construction. Okay. Now that escrow account is going to, it's not money that you can just go in there and grab money and pay for things. Okay. No, the way that it works is a reimbursement uh, um, system. Okay. It's a reimbursement system, meaning that, okay, you have $35,000 in escrow. Okay. You're going to have to use your own money. Okay, you're going to have to go and let's say that you divide this in three stages. Okay, you're going to go and use your first $10,000. You're going to need $10,000. Okay, to start the project. Okay, So you go, you start the project, start demo, start doing, taking the doors down, taking the all the things that you're gonna take out of the property, and you start putting new things, right? So once you get to your $10,000, you go back to the bank and you say, hey, Mr. Bank, I did my first part, I need my first draw, right? I spent my first $10,000. Can I get my money back, right? The lender is going to send out an inspector over to the property. He's going to make sure that you did that, the first stage on your deal, and then it's going to refund the money that you spent, right? Some some of the private lenders that we use, some of them they require receipts, some of them they don't. Okay, they're just gonna take they're gonna believe what you say about what did you do, but at the same time they're gonna send out the inspector and they're gonna see that the work has been done. Once they do that, usually, and these takes just a couple of days. Usually, you request your draw the same day. Usually, the inspector is going to call you and say, "Hey, are you available tomorrow? I'll stop by your house." And you say, "Yes, I'll be there." Okay, he goes, boom, 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 takes some pictures. He sends that report right away to the bank. By the next day, you should have the money. You're going to have an email saying, "Hey, the inspector saw this. We think that we're going to send you 9,500. Is that okay with you? Approve the wire. Yes, boom, boom, wire sent out to your bank. Okay, and it gets sent out directly um, to your company account, right? So that's something that you're going to set up from the beginning. So the idea is that once that happens, you're gonna do that over and over and over with the different draws that you're gonna do. Once you do the second stage, you do it again. Your third stage, you do it again, and then the last piece of the money stays on the escrow account until you're completely done. So you're gonna need extra additional funds, even though you're getting 100% of your um, of your rehab cost. Now, once you're more experienced, once you get more experience on your deals, once you have more deals under your belt, our lenders are gonna, some of them are going to be willing to advance some of that funds for you to kind of get started. But I would say don't count on it. I never did. So if you can have your own money, your own line of credit, your own cash to do these, to pay for that stuff first and then get reimbursed by the bank, that's way better. And sometimes, you can work, if you work with a contractor that has the credit power, it doesn't have to be your credit power. Sometimes, can be your contractor that has that power to upfront the cost of the construction. If it's not a big project, $10,000, it might not be very difficult for them to do it, right? And then you pay them back those $10,000. That's why, one of the main things that we teach our investors and we help our investors with is to make sure that their scope of work is as tight as possible with their deals, because that affects the way that you do your draws, okay, the way that you do the work. So your scope of work, it has to be very in touch, very connected with your timeline and the way that you're going to do things, right? So, okay, first I'm going to, I don't know, just to give you an example. On this property that we were talking about, right? On this particular property, some of the things that we're looking to do is to change all the doors, all the hardware, scrape, paint. So all that stuff has to be first on our scope of work, has to be first on our first stage, right? All the things that we need to demo, right? If we need to take any panelings on the house, if we need to take any wallpaper, if we need to take carpets out. So that's mainly, it has to be on your scope of work, which is demo, right? Demo or preparing the property for the new stuff. So first, we're taking everything, the old stuff that we're replacing, right? And then we're starting to put new things. So if your first part is that, you need to make sure that you put that on your scope of work, that you first are doing that. So that way the bank understands, and when they come back and they refund your money, it's like, okay, because we were doing this work, right? And not just say, hey, new kitchen, $10,000. Inside the new kitchen, there's a ton of different things: cabinets, countertops, faucets. If you're doing any electric, if you're doing any additional plumbing, if you're putting new appliances or floors or paint, all that stuff has to be make sure that it's itemized as much as possible. So that way, if there are things that are not done and you're not going to be able to recuperate, to make sure that those are counted on a different draw. Okay, so those are things that you really really have to have in mind when you're taking that in your deal. Let me see. I have a he says, how, so this Kira is asking a question. Sorry, Kira, I just saw your question. It says, any recommendation for which hard money lenders to use to fund a 4-unit building with a basement? The property would be in Chicago. Well, I mean, yeah, contact us, and I can put you in connection with some of the private money lenders that we use here in Chicago. There's many of them. It all depends on your particular situation and your particular experience, right? If you have experience, there are certain lenders that are better than others. Or if you don't, this is your first deal, then we're going to help you establish that relationship with that private lender, so that way you can keep doing your deals with them. The idea is to start the relationship with one, see if you like it, see if you like the people you're working with, see if it's easy enough for you to understand it, and then keep doing more deals. Because usually a lot of investors, sometimes they're going after, oh, that lender offered me a better interest rate. But you have to look at the overall picture. It's not only about interest rate, but it's also about fees for closing, or fees for throughout the project. Every time you draw money out of an escrow, it's going to be a charge for that as well. And then the efficiency of the bank is something that you want to know. It's something that is not going to take a week for them to return your money. You want something that they return your money as fast as possible, so you can keep moving, right? So definitely, I'm gonna give you my contact information in just a little bit. So get in touch with me, and I can help you out getting that property, that lender for that property that you're looking to work with. And based on your experience, we'll look and see what level of financing you can get. Okay. So hopefully that helps. And then at the same time, we work with all the other tools that we need. Now we're gonna go over a little bit. One more thing that I wanted to show you is kind of some of the things that you're gonna use for some of these projects. The type of money that you're gonna be using. So I'm gonna change the color a little bit. So we're gonna be looking for all these part is going to be hard money, right? Hard money or private lenders. For these, you're going to need your cash. For these, you're going to need your cash, and for these, you can use either cash or line of credit. Okay, so private lending, hard money lending, and this is your own cash or business lines of credit. We've used business lines of credit all the time, and the business lines of credit are perfect for these type of things. Even perfect for small cosmetic projects, okay, in which you need to go in and out. So when you use 0% business lines of credit that we can provide, these are perfect for, quick jobs, and even for, jobs that takes you anywhere from a month to 3 months or even 6 months. These are great tools to use when you're flipping properties. Okay, when you're doing rental, the same thing. If you're buying rentals, you're buying properties to fix them and rent them. This is a great tool as well, because you can buy the property fast, get the work done on the property, rent the property out, and refinance it into a new loan in a 30-year loan. Okay, we can do all that stuff and help you get that all accomplished with the lending products that we have. Okay, so that being said, this is it for me today. If you have any other questions, feel free to send me a message and text me, and I'll be glad to answer any questions that you may have on your particular situation. So again, if you wanna talk about your these type of loans, let me show you where you can get in touch with me. Here's a phone number where you can get in touch with me. You can call me at 847-220-7247, or go to getunsecuredcredit.com and just set up an appointment. That website is just for you to set up a time to talk with me, and we can go over your particular situation. I can tell you exactly how we can structure your deal and how we can help you get the best financing possible for that transaction that you're planning to do. Okay, but feel free to call me or text me directly at 847-220-7247. And at the same time, you can, get in touch with me, connect with me on social media. You can reach me on Facebook.com, LinkedIn, Instagram, or Twitter. Usually, Facebook and LinkedIn are the most active, where I'm there all the time. So if you responding any questions that you may have, so feel free to connect with me on those places. And you can also go to my website at christianarce.com. So without further ado, I hope these help you. I hope these help you understand a little bit more about the structure of the lending. We're going to keep doing these so you can understand, and repeating these things, so that way you can understand how to structure your deals. And if you have any other questions, please feel free to give me a call. Again, 847-220-7247. And see you on the next one. Thank you, guys.